I see in the studio, I see not only your snowshoes, but your Bernie Sanders mittens. It's looking good this morning.
I live for this.
Exactly. So, there's lots going on, and there's no question that the story of the day was, Robinhood and GameStop. And if you haven't been following it, we're going to give you just a little bit of a preview to kind of understand what is happening. So, before we get started, there's some terms that we're going to throw out, and it's going to start with Todd. What is shorting a stock? How would you explain it to our listeners?
Well, I'd start off with 4 transactions. You could think of buying a stock in a traditional sense. You buy and then you sell. Shorting, you sell and then you buy. So put a couple words after it and you say, we buy to open, sell to close. We sell to open, we buy to close. So selling to open, how do you sell something that you don't own? You borrow. The borrow is where the term margin comes from, and you pay interest on that margin. So, you can buy to open and sell to close traditionally,
yep,
or you sell to open and buy to close.
Right. So what is happening, people are looking for these heavily shorted names. In other words, people that think the stock is going to go down, and that's the reason why you short a stock, Derek. You think it's going to go down. So this whole thing that's been happening, I want you to try to explain it to our listeners.
Well, I would term it a short squeeze. And essentially what happens, you think about a hedge fund, they're long stocks, meaning they own them. They're short stocks, meaning they've borrowed stock and they're hoping it goes down. The problem with a short is when it starts to go against you, it becomes a bigger and bigger position. And that causes shorts to cover, in other words, liquidate their short position because they're losing money and their portfolio is getting out of balance. So what happens is when you've got a collection of people on Robinhood or big institutional traders who are gunning for shorts, their buying power, whether it's through the option market or the stock market, changes the risk ratio and forces, it becomes a self-fulfilling prophecy where buying leads to more buying, which leads to more buying, which as a result, a stock like GameStop this week had a range of $19 to $483 this year. It was up over 300% on the week.
Yeah, that's crazy. And so, people are watching this, Danny, and there's these young people apparently on one of these subreddit sites, and they're saying, wow, let's go. Let's give it to the suits. Let's give it to the hedge fund managers. And the young people who got $600 of stimulus money are making tons of money.
Well, and each guy is then telling somebody else, and right, that just whips up the frenzy. I mean, have you seen this much interest in just the markets in general? I mean,
no.
The guy asking for money up in Green Bay and Capital was asking me about it.
Yeah. No, I haven't. And what it's doing, unfortunately, is it does appear that some of it's turning into casino-like action. And that's the scary part, because our clients and our listeners say, I've saved my entire life to get this money. This is what I have. And therefore, when you start doing that, it makes people nervous. And that's what we're seeing, Todd.
Right. And what you're actually seeing is the speculative excesses in the market. So when you see a lot of small investors coming in and buying, there's an old theory called the odd lot theory of investing. It says do the opposite of what the small buyers are doing, but it's more than that. So the social media push and targeting particular stocks and driving them higher, it's the technology that's facilitating that. But to Derek's point about short selling, the short sellers thought the price was already high and it's going to go down, but yet it goes even higher. So then they get squeezed and they have to buy back to close at higher prices.
And sometimes they have to sell good stocks to do that. He makes a good point, Derek, the fact that the technology is there. And what he means is these platforms like Robinhood. Please explain that.
Well, Robinhood, all of them, E-Trade, Fidelity, they have scanning software on their website. So you can look for companies that are trading unusually high level of volume, up a lot, up a standard deviation in price or something like that. But what I really have come to the conclusion on this is it's really an indictment on the regulators and the brokers. How, in God's name, how can you actually allow somebody to short 140% of the float of a company, which was the case of GameStop? Obviously, the regulators messed up and the brokers as well.
Yeah, please don't indict any regulators, because if they're listening,
we love them.
We love those regulators, and they have badges. And so that's the things that we want to worry about. Now we want to move on to more of the numbers and the fact that despite what we saw on Friday, a down market. It kind of played into where we are right now. How did we do for the week, Derek?
Well, for the week, the S&P was down a little over 3%, as was the NASDAQ. Small caps, which actually have been very strong since the election, were down 4% for the week. But to put that in context, we're up about 9 to 10% since the election. Interest rates still remain low. The 10-year, in fact, backed up a little bit this week, finished at 1.1%. And earnings growth has generally been really strong throughout earnings season.
Yeah, and so the other thing that we want to pay attention to as well is this is the beginning of earnings season. We talk about this often, and this is when the publicly traded companies have to put out their report card. And so a lot of stuff is happening, and some big names came out, and not only did they do well, they didn't react well.
For example, Apple reports revenue up 21% year over year, earnings up significantly, and yet the stock trades down.
Right.
That's not unusual. When you got a peakish market, people are not buying into this earnings growth and revenue growth numbers. So you know that stock prices gyrate around earnings, and you know that it'll follow the path of earnings every year to year, and you'll have your peaks and troughs around that earnings trend. So this is one of those periods where, yes, you have an earnings peak, as Derek was talking about, since the election. It's probably historic, the gains in the market since then. But that's driven by speculative excesses, too, as we were talking about. So you can sit tight if you get a little concerned. Like we may adjust portfolios to the low end of the risk scale for different objectives, but you don't make rash decisions and get all out or get back in.
Yeah, trying to get out and try to get it back in. That's timing the market. But big names, Facebook, Microsoft, Apple, and Tesla all reported this week, yet they didn't move. How do you address that?
Well, we actually talked about this last week. If you recall, we talked about the banks and how they didn't react to good numbers. And we said that essentially one of the risks of the market on the near-term basis was the fact that we had advanced so much. So it does lead to some element of profit taking. And then it's been aggravated by what we've been seeing with GameStop and costs, headphones, and the rest, where shorts are forced to meet margin calls, and one quick way to meet a margin call is to sell your winners like
right.
Apple, Microsoft, Amazon, and the rest.
And so stuff that is doing well is being sold. And so when people say it isn't affecting me, it kind of is in the short term. People that have to cover those stocks, but it's not just these hedge funds as these online sites are being talked about, Danny. There are other people who are being affected by this.
Yeah, that's what I was going to ask, because there's almost a societal thing here where it's like, yeah, stick it to those rich guys.
Right.
But you know what? Big hedge funds, even like pension funds.
Sure. You think about large pensions, you think about teachers' unions.
Or even 401ks.
State pension funds. When they allocate capital, one of the things they allocate to is a hedge fund.
So don't cheer too much at this, because it's affecting all of us, right?
Well, it is. And no one's here to try to defend the hedge funds, the billionaire hedge funds. We're not saying that. We're saying that if you are a teacher and you're in a teachers' union and that money is being allocated to a hedge fund and the hedge fund is getting hurt, then we're all being affected by that. And that's one of the things I wanted to point out, Derek. And from here, the other thing I wanted to cover, too, is the fact that we have some economic news that we're watching as well.
Yeah, the GDP came in pretty strong at 4%, of course, slower than third quarter, which was unprecedented. Remember, we were up 33% annualized. So the U.S. economy going into 2021 was still fairly strong, but it had slowed. We've seen that in the labor market data. We've seen that in continuing unemployment claims. And that's one of the reasons why the Biden administration is suggesting another $1.9 trillion of stimulus spending to essentially get to the other side of the crevice caused by the pandemic until things are more normal.
And when that happens and we see more debt issued, we have to service that debt. And that servicing that debt, it comes from the interest rates that are out there in the public market. And we are paying attention to the interest rates right now, because if that debt continues to rise and the interest rates continue to rise, it costs more to service that debt. It is something that we have to pay attention to. And it's not happening just right now, Danny. This has been going on for 15, 20 years. The debt continues to climb in this country. It once gone from $4 trillion to nearly $30 trillion, and that's why we're talking about it.